What I do is, which is very much more long-term thinking, is very much about thinking quite hard about the business model of the company. How do they make money? What is the value of what they do that keeps other people from coming in and taking their lunch? So that is maybe a different skill set around thinking really quite deeply about where a company sits in its value chain.
Hello and welcome to the Fund Your Retirement Podcast, a guest-led podcast aimed at sharing insights and strategies that help you build long-term wealth. Today I'm delighted to introduce Rosemary Banyard. Rosemary is an award-winning fund manager specialising in the UK medium and smaller companies and has over 30 years of experience in understanding business models, industry structures, barriers to entries and risks on both the buy and the sell side. Rosemary talks about her investing journey and how it's evolved over the years, discussing some of her best investments and some of her worst, investor red flags to look out for in company statements and accounts, and of course much more. Just before we do get started though, please note this conversation is for educational purposes only. All opinions and information are for educational purposes and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. If you need financial advice, please consult with a regulated financial advisor in your country before making any financial decisions. Rosemary's fund, the VT Down in Unique Opportunities Fund, may or may not hold investments mentioned in the fund at any given time. That being said, let's get started. So, hello Rosemary, thank you for joining us today.
Hi, Lee.
How did you get started on your investing journey?
My background was a family that had no background in investing. And I went to university and read classics, Latin and Greek. My story starts on graduation day, and I had not really any idea what I was going to do. I didn't want to teach. I didn't want to do academic research. And I had applied really a state of ignorance for certain things that were university types of applications for big companies. Got nothing. And on graduation day, another girl in my college, I was at Clare College, Cambridge, a girl called Claire Barnes, on graduation day, she said to me, Rosemary, what are you doing? And I said, I don't know. And she said, you should look at stockbroking research. She said, I've got a job with WI Carr, which was a well-known Far Eastern broker. And I'm going to be doing sort of research into companies, and I think it's a really interesting area. Why don't you look into it? And that single comment
That was the start.
That was it. I haven't seen her since.
Yeah.
I think she's written a book. She stayed in Asia. So I think she probably has no idea. So I went to the careers service, because this is way before the internet, and got out all sorts of files and started looking at it and thought, well, actually, I could see myself doing that, getting to know an industry. Could be quite interesting. And I wrote letters to 4 firms that had advertised the most recently. I was quite late by this stage in the process. And 3 wrote back and said, sorry, we've filled our vacancies. And 1, James Capel, which was a well-known name in research then, said, come and have a chat. And I got 1 job offer. It wasn't actually in research. It was in a sort of a part of private clients, but it was foot in the door.
Yeah. What sort of time frame are we talking here? Am I allowed to ask that question?
I think there's something relevant about the answer, which is it was the year that Margaret Thatcher became Prime Minister, 1979. So I have to say that this is not about politics, but you are influenced by the politics of your day, I think. And when you look back at the things that she did, and people absolutely love her or hate her, the things that were relevant to this conversation were lots of privatisation, belief in a small state, addressing supply side shortages and constraints, and things which the present government could usefully remember,
Yeah.
I might suggest.
So you literally got started in the early 80s on your journey then?
I did, yeah.
What was that like in that period? Because I'm guessing there wasn't too many females in that sort of finance environment back in those days, was there?
Yes, women had only been granted membership, the ability to be members of the London Stock Exchange in 1973, so 6 years earlier. And that was a big thing then, because in order to be a partner in a broking firm, and they were all full partnerships then, not unlimited liability partnerships in those days. In order to be a partner, you had to be a member of the stock exchange. So you couldn't rise to the most senior levels in a firm until 1973. So by the time I started, there were 2 women partners at James Capel, both of whom were, I recall, fearsome women.
Yeah. It would have to be, wouldn't it?
They would,
in
wouldn't
that
they?
time.
One, Ellen Windsor, was I think she went on to chair Lion Trust many years ago or something like that. And the other was a lady called Haruko Fukuda, who was head of the Japanese department. And I found them both absolutely terrifying. But yes, it was very early days. And most of the time since then, it's been my experience that most of the prejudice or that comes has been unconscious, actually. When you come across it, it's thoughtless rather than
Yeah.
malicious.
More unconscious biases than actual
Yeah.
intentional, deliberate
Yeah.
sort of actions.
Yeah.
Yeah. How has the industry
How has it
changed?
changed? Yeah. One other big change, and I know that since COVID, it is working from home. So I stayed in broking for 12 years and then eventually got into the buy side, into fund management. And then I got to Schroders. And in the year 2000, there was the Hatfield rail crash. And I live in Cambridge, and have done for years, and I just couldn't get to London
Mm.
for weeks because of this crash. So I agreed with Andy Brough, who I worked with for many years, that I would work from home quite a lot. And then when it's all settled down, it became a thing that I work from home 1 day a week. But it was not official. It was not hidden. My boss knew, everybody knew, but it was on the voicemail or whatever, but it was not official. So I'm pretty sure I pioneered working from home for
In the early
Schroders.
2000s.
Yeah.
Yeah.
And initially, at that time, I remember it was viewed in some quarters as that you were slacking. And a lot of the men didn't want to do it because they thought they would be viewed as slackers. But that did change over time and it became official. It became a sort of a regular thing. And a lot of analysts, particularly, did it regularly. And we ended up with analysts who lived, for example, in Aberdeen, who would fly down on a Monday and go back on a Thursday and work from home on a Friday or whatever. And it became quite normal and not something that evoked sort of concern. So that
Yeah.
was a positive change, I
So
think.
you were a bit of a trendsetter then. You were early into finance. You started working from home in the 2000s, long before COVID 2019. And fast forward to today, now you're a fund manager at Downing. Would you mind sharing your overarching strategy? How has your strategy evolved over that time into where you are now?
Yes. So you're right to say that my sort of strategy, investment philosophy has evolved over time. And I'm not ashamed about that because I think that's a positive thing that as you learn more, you add things in, you develop. And so there has been an evolution. I'd say that there are several things. So firstly, working with Andy Brough, I worked with him for 18 years. He is an accountant and very hot on reading accounts and making very sound and detailed deductions. And, I very much was grounded in that from quite early on in my fund management career, looking for the warning signs, comparing first half, second half splits and all sorts of techniques. So that was with me for a long time. And then I also had a bit of a change or perhaps a focus from about 2008. So there was a book published. It's called The Little Book That Builds Wealth, written by a guy called Pat Dorsey, who was head of research at Morningstar in the States. And it was talking about moats and barriers to entry, and it was categorizing companies and saying what the kind of barriers to entry were. And it really hit me that this was quite an obvious thing to be looking for.
Yeah.
Now it's often talked about, but it was perhaps less so then, hence the book. So I started qualitatively to be hunting these businesses out, probably much more explicitly from then. And then I suppose that things moved on because that was a subset of what we did at Schroders. We had lots of money to run. So there were also turnarounds that we invested in and things like that. So when I left Schroders and set up my own sort of single fund, there was a quantitative addition to that, which was very much saying if a company has got these barriers to entry and they're durable, it's going to show in the numbers and it's going to show in probably in the return on capital, the return on equity. And so starting to overlay much more explicitly that to the method.
Would you mind sharing a couple of companies that kind of exemplify that? So what first drew
Yeah.
you to the
Yeah. I should add that there's another thing I have increasingly come to favour over time, which is skin in the game. I don't make it a prerequisite that management has to have a big stake because you find with larger companies that's often not the
yeah.
case, but it's definitely a preference. And my present fund, 10% on average of each company is owned by management, which is a big spread from very
Yeah.
high stakes to not much. So some examples. So a company which I invested in not at IPO, but quite soon after is called KNOS, and it's a technology business. And it has very good returns on equity, over 20%, and net cash. That's suppressing the return on operating assets much is higher than that. So financially, it fits the bill. It definitely fits the bill in terms of skin in the game because the founder directors and the chief exec, the finance director, and a couple of heads of department all have significant shares in the business, having come out of private equity ownership into IPO. So that ticked the box. And then you start looking for the moats. Why is it that this business has done well in private equity, is still doing well? So it has two divisions. One is providing the digitalization of government, central government processes. So the one that's easy to understand is passport application, which is now online, having been, as people will know, a paper form for years and years. To illustrate, so I actually had to apply for a new passport only about 3 weeks ago and went through this newish system, which they've done. I have to say it was absolutely brilliant, and the whole process took 6 days, including a weekend. But I happened to then be talking to them the day after, and I said, guys, I get why it's good for me as a citizen. It's much better. Why is it good for the government? And they said a quarter of applications used to be rejected for inaccuracies. And the two main reasons were people put in the wrong postcode for their house.
That's
and
right,
then the
yeah.
other one was they put today's date for their date of birth. If you're on a digital version, you can easily eliminate that one.
Yeah.
Reject. And it saved the government 60 million a year.
Wow.
And then so you start to see why this company has got a valuable position, and that if you start to get a reputation for delivery on time, you're going to get more business from a government that wants reliable, on time digital processes to be installed. And the on time is very important because if they already have some provider and they're going to sever that contract, if you're late delivering the new version, they're going to have to renew that contract and they'll be charged absolute arm and a leg. So it's very important that they're dealing with people that they trust and who they know can deliver. It's perhaps not obvious until you start thinking about it. And then, yes, they are very much a favoured supplier.
So there's room for growth there as they.
Yeah, oh, totally. I think the gold standard is Estonia, which is like 99% digital in everything to do with government, because they had to redo everything after they left the Soviet Union.
You can see that's a big market for them to go after as well with
Yeah.
digitalising government processes.
Yeah. And they have another area, I probably won't go into it, but it's to do with installing Workday enterprise software, which is taking over the world from Oracle. One thing that's interesting is I do look at the numbers and I do read the annual report, and I think it's still an underrated document. And if you look at the KNOS annual report 2021, they say our ambition is to be a global independent company operating towards the disruptive end of technology that will thrive not just today, but for generations. And then they say later, it is our preference to grow organically. We will undertake acquisitions only in exceptional circumstances where we need to obtain unique skills. So I really like that because it speaks, doesn't it, to conviction, to being different.
Really thinking very far into the future for generations to come.
Yeah. But you did ask me how I discovered it. And this one is a bit unusual, but a competitor of mine introduced me to the chief exec at a dinner in Oxford. We were on a sort of 2-day broking event. And he came up and he said, Rosemary, I want you to meet Brendan Mooney. He runs a really good business. I'm not proud. I think you can get good ideas from competitors sometimes.
I take it you still own the company then?
Yes. So I bought it originally from my previous fund at about £2.20 a share. And then I bought it for the fund I've been running, Downing, being at about £8 or £9. And the shares today about £10. They did get as high as £20 in the euphoria, the summer of 2021. Yes, there was a sort of love affair with everything digital.
Yeah, everything tech because of the working
everything
from home.
Tech, yeah. I did sell a few shares at £20 because they were really very highly rated, but I didn't sell out. And I think that's quite common for me. I'm very much a long-term investor. And I also think it's quite hard if you sell out completely to buy back in. Whereas if you've even halved the holding, but you've still got some, then if it comes back as you think it might, you can then buy it back. But I found, humanly speaking, if you've exited something, it's quite a lot harder to buy it back.
So is there another company there that would be of interest as well?
I probably will give another tech example. Actually, so IT is about 20% of my fund. This is a company in the area it's called VMS, Vertical Market Software. And actually, what you find certainly in the UK these days, is that a lot of the software companies that haven't already disappeared, been taken over, are software companies that dominate a particular vertical, and they have expertise with a particular industry, and they can often be a very valuable thing. You can dominate just that
Yeah.
vertical. You're totally focused on that rather than being an enterprise software bought by lots of different industries. You're in
Yeah.
this one vertical. And actually, if anyone's interested, there is I think it's Canadian listed company called Constellation Software, which has been incredibly successful for decades, buying up small vertical market software companies all over the world. So they recognize that it's a really interesting area. So the one I'm going to talk about, and I've got a bit of a black armband on today because it's called Alfa Financial Software, and it's just announced a takeover approach. And I view that as negative because I don't want to lose good businesses. But Alfa actually floated, and it came onto the market. I think it wasn't owned by private equity, actually. It was founder owned. A lot of IPOs come from private equity, and one needs to be careful. But with both KNOS and Alfa, because they were effectively privately run, founder run, you could go back into the company's house accounts, going back as private company, and go back quite a long time and see the record quite easily. So that's good. But Alfa floated at what turned out to be just ahead of a downturn. And so it was a bit of a classic IPO that didn't do well. But there's nothing wrong with the business. It dominates the market for leasing software. So whether you're leasing a car or a piece of agricultural machinery or office equipment or an aircraft, if you think about the leasing process, it's quite complicated, and they're global. So different countries have different rules. There are different interest rates which change. You've got the whole thing about initiating the lease, and then you've got the payments over time. You've got the accounting, and then you've got coming to the end of the lease, and maybe you want to extend, or people might default. It's very complicated stuff, and having a specialist is a good thing. I could instantly see that it's clearly a global business because it's got global customers, and it's specialising in this area. And the incumbents tend to be people with software that's been around a long time, so it may not have been updated enough, and there's an opportunity there. When I started the fund at Downing, and this was during COVID, Alfa had become hated because of an IPO that let people down. And it seems almost incredible now, but it got down to a price of, I think it was about 60p a share, and I started buying it, which is a market cap of 180 million. And it had, I don't know, 30, 40 million of cash, which is given back. And it was on, I think, twice revenue, something like that. For a global leader is about as good as it gets.
It is, yeah. So what's the price at now?
The bid is 208.
Yeah.
But they've given, but I think I must have had 2/3 of my money back in dividends already. Yes, we all love to talk about our successes, don't we?
Well, that's a good transition, actually, because this is one that you might not want to talk about. Maybe could you share a couple of companies that have ticked all the boxes, obviously because you've invested in them, but didn't quite work out as you expected? And when was it that you realised that something had changed? And then what did you do? How did you deal with that, and what were your kind of steps? Because for private investors, this is a common area of concern. Buy a company, ticks all the boxes, but then something doesn't quite work out. When do you get out? When do you make that decision?
It's very hard, isn't it? So I think my worst ever decision at Downing in the last 3 years was I bought a company called James Fisher. And this was the power of the preconceived idea that I had known this company for 15 years at Schroders, and it had been a good business run by people with a big focus on return on capital. They'd always had quite a bit of debt. So it's a business that was involved in marine services and lots of different niches. They refuel Royal Navy ships. They are involved in submarine rescue, provide high voltage expertise for offshore wind farms, and they've got diving expertise for inspecting oil rigs under the sea. And you start to talk about all these things, and there's quite a specialist areas.
Yeah, they're all specialist areas, aren't they? They're quite niche. you say?
Yeah. So it's entirely was my mistake, but I got totally carried away with what I thought I knew the company to be, but I
Mm.
hadn't looked at it for 2 or 3 years. And they had basically got into some lumpier business, including in the Middle East, which is usually tricky. And the debt had gone up, and some of the businesses that they'd been in started to not be as lucrative as previously. And I just made a mistake over a period of a few months, a couple of results, started to think, oh, wow, this one really is deteriorating. And then at that point, if you've got a lot of debt, then you have a problem, because there's nothing like the power of debt to undermine the value of equity and when things go wrong. The majority of my investments don't have any debt.
Is that kind of one of your key rules?
I'd
Or to
prefer
low debt, no debt?
low debt, no debt. We all, I think, well, you have to be incredibly robust to never be lured into
Yeah,
stretching your own
of
rules.
course.
And it was a stretch. It was on the edge of my kind of ratios when I bought it. And then, of course, it deteriorated. Yeah, I cut it painfully. I took a loss. I think I've just felt in the end, look, I can do a lot better than this. We could sit there and wait maybe quite a few years, and it probably will recover. There's some new management in who seem very capable and sensible, and indeed it may be an interesting turnaround. But for me, there's better quality businesses out there. Just
Yeah.
sometimes you've just got to.
You mentioned there about the turnaround. That's the problem, isn't it? That we can somehow try and then fit a new narrative over an original idea, isn't it? Oh, this actually might become a turnaround, but that
I
wasn't
think
the
that's,
original
yeah,
purchasing idea, was it?
it wasn't the idea. And it's also one of the things, it's this parallel point that one of my sort of warning signals is if the narrative changes.
Coming from the
So
board, the CEO
um,
statements, things like that.
yeah, and suddenly your strategy's changed, or your focus has changed, or you hear those dreaded words, strategic acquisition, as opposed to bolt-ons, and or whatever it is, and it can be a red flag, I think.
Yeah. So it's a red flag for you, narrative changes. And it's a good example of that. Thank you for sharing. So how many companies do you hold, Rosemary, then?
So at the moment, I've got 31 holdings. My fund, the prospectus says I can own between 25 and 40. It's roughly in the middle of that. And that's a deliberate choice to run a reasonably focused portfolio, which has positives and negatives for investors. So it will be more volatile on the way up and the way down than somebody that's more closely following an index. So 31 companies. Of course, a lot of them I've known for, indeed most of them I've known for a very long time. And so I think in this industry, knowledge is cumulative. So every time I'll read a set of accounts or a set of results or sit on a call with a company, I'll learn something new. And I think it is cumulative.
How do you find these types of companies? How do you come across them?
I use screens looking at high margin businesses, high return on equity, high
Yeah.
return on capital, no debt, financial security. And also, I'll just do a screen on something like free cash flow yield just to knock out things that are really fancy price or inadequate cash flow. So I'll do that. But a lot of it's just trawling around, sitting on group calls, just having a once over look at something. And then if it's interesting, doing more work. And if
Yeah.
it's not, we'll look at it again in a few years. Lots of webinars now as well. And
Yeah.
a lot more companies are accessible on that
Yeah.
route.
PI World put out a lot of webinars, so they launch a
Indeed,
lot
they're
of
very good.
companies. Yeah, that's another good resource, PI World. You mentioned a really good example there for a red flag for a company with the management where the narrative changed. Have you got an example of any red flags in accounts that have made you think twice, where things have changed in the accounts?
When I was at Schroders, talking about technology again, but there was a company called iSoft,
Yeah.
which was selling software into the NHS. It was the holy grail of redoing all the NHS's computer systems, which obviously are all much of a hodgepodge. And they won some national program for IT contracts, and it was all very exciting. And then a set of accounts came out, and I can't actually remember the exact details, but in the small print, there was basically a massive gap between the profit and the cash flow, which is always the big red flag. And so I think what they've done was they'd bought some other businesses and they'd taken up front some revenue, but it didn't have the cash attaching to it. They just booked it as revenue. And we sold out, and it turned out to be a big fraud, actually.
Oh,
It was later. But the main message is that at any time you should check whether there's a big difference between the cash flow and the profit. So you can compare the operating profit with the operating cash flow, or the after-tax profit with the free cash flow. And if there's a massive difference, you just need to go and start asking why. And sometimes it's difficult because it doesn't always mean you should sell. There could be some reason which is genuinely a one-off. And actually in COVID and post-COVID, that has been the case. So a lot of companies, for example, who make things physically have had to increase their stocks because of supply chain issues and having to be in stock because they couldn't rely on getting things. So that's been quite a feature. And it isn't necessarily that they're all trying to pull the wool over your eyes. It's a genuine reason. But you just need to keep an eye on it because it can distort not just the cash flow, but you've then got to unwind that stock. Are you able to sell it at the original planned price?
Yeah.
So try and think about what the product is. Is it something that's going to degrade and you've got to discount a lot? That's one question. And also, you might then have to slow down your manufacturing plant because you've got too much stock. And then you're going to have some other implications further down the road, probably margin going down. Yeah. So if you see anything like that, you've just got to start asking sort of real world questions about why is this number high? What exactly is it referring to? And am I happy that it will sort itself out over time? Or is it a red flag? Accrued income is another one. If a company can report in its revenue something called accrued income, it's in the notes, receivables notes, and they're basically booking income, but they haven't yet. It's in advance, really. If that number has suddenly shot up, you just need to try and understand why they're suddenly booking this income and whether what it relates to is going to materialize genuinely or not.
Yeah. Very similar actually to the recent fundamental asset podcast with Chris Boxall. And he said one of the red flags that investors need to look out for is cash flow versus booked profits. It can be a red flag.
Big
that line.
divergence.
Yeah, it's a big divergence. Yeah. Yeah, it's
Yeah.
really good. Can you share a bit of an insight to the differences of being a fund manager versus a private investor?
So I think as a fund manager, it is still true that you get more access to management. I don't think it is such a big gap as it used to be. And I personally think that's a good thing. So we've already talked about these PI World interviews. There's Investor Meet Company and all these
Yeah.
webinars that you can join. You can ask questions and you can hear other people's questions and the answers to them. And there's much better access. I think it is still true that not so much with very big companies because they tend to deal through investor relations people, etc. But with medium and smaller companies, a fund manager can have a meeting one-to-one and I guess then explore in more depth perhaps some themes that they might wish to do and possibly just gain a deeper or more extensive understanding maybe than a private investor just sitting on a webinar who might get one question in but won't get several. Yeah.
Yeah.
So I think that's just a comment I'd make. But I would say that it is a criminal offence for a company to tell some selective price sensitive information to one group of people and not everybody. And in my experience, the companies that are of substance on the market all know this perfectly well and do very much honour it these days. And so I don't think that the difference in being a fund manager is that we're suddenly getting some
Secret
insights that you're
information.
not getting. It's not that. It isn't that.
Yeah.
It's just perhaps a broader or slightly deeper understanding of the business than is just possible in a group environment. But I sit on a lot of group calls with other fund managers because it's good to hear other people's questions and it's the same for private investors, isn't it? You hear other people's line of questioning and you learn things.
Yeah, different line of thinking. That's the idea with what we're trying to do here with this podcast series by bringing on people like yourself and many of the well-known private investors. It opens up the understanding and awareness of how you think, how Chris Boxall thinks, how Maynard Payton thinks, and people can integrate that into their own investing philosophy and strategy. Is there any pressures that you've felt from time to time and as a fund manager?
So Andy Brough, you used to say you're only as good as your last quarter. And he was slightly tongue in cheek, but it is still the case that we are intensely watched for performance. And if you go onto TrustNet or something, you can see all the funds, can't you? And you can see daily really where they're positioned in compared with their peer group. Daily, weekly, monthly, quarterly, etc., etc. So it's a very live environment. So if I've had a year where I've lagged my peer group, I will feel the pressure, not the pressure to change. I think I'm very much convinced that people want you to stick to your knitting these days. So if someone's investing in your fund, they want to know that Rosemary is always going to go for quality companies with high returns and long-term compounding potential. They don't want me to be flitting around because suddenly exploration's in vogue. Yeah. But it doesn't mean you don't feel the pressure.
Yeah.
Well, I'm very competitive. So I'd like to be doing well every year compared with everybody else.
That's really good. So as we come to the end of the podcast, just a couple of questions, but what do you say makes a good investor?
I think there's different answers because there are different skill sets. And I think there are perfectly valid different ways to approach investing. For example, you hear a lot about value investing. Now, I would say you need to define it quite carefully because there are at least two definitions. One is buying things that are cheap on PE, book value, high yield, or something mathematically cheap and trying to find a subset of those. Or it could be more my definition that they're intrinsically cheap compared with their intrinsic worth, defined the present value of the future cash flows. So you've got to be careful what you mean by it. But you can be somebody who is deliberately out there looking for companies and you won't pay a PE of more than 10, 12, 13, whatever number you pick. That could be a very valuable strategy for people who are good at making sure they don't pick value traps, bad companies. And you might be somebody who's very good at that. I think you must have curiosity and genuine interest in business. And probably you're going to be somebody who's, when they're out and about in their daily life, sees something and relates it to investing. It's in a slightly obsessive way. It might be something very simple. Oh gosh, all the restaurants in my hometown are empty at the moment. I wonder why, kind of thing. Or there must be some curiosity, I think, about the business world. But then at the other end of the spectrum, in a way, what I do is, which is very much more long-term thinking, is very much about thinking quite hard about the business model of the company. How do they make money? What is the value of what they do that keeps other people from coming in and taking their lunch? So that is maybe a different skill set around thinking really quite deeply about where a company sits in its value chain. Probably helps to have some understanding of economics there. But
yeah, brilliant. And finally, last question, you'll be pleased to know. Book recommendations. Do you have any books that you've learned a lot from? And
yes, lots actually, but I'm not going to give you them
yeah,
all. I have behind me a couple
I
of
can see.
shelves
Yeah.
of investment books, and I read a lot because I'm very much of the view that you can learn so much from other investors. The one I already mentioned was The Little Book That Builds Wealth. The thing about it is that it is about American companies, but it just gets you thinking about what are the protections to the company I'm looking at to keep out the competition. And I think just reading not so much the examples, I say they're American, but the text around that I found quite helpful when I finally read it. And the other one I've got, like many people, I'm a great admirer of Berkshire Hathaway and Warren Buffett, but his partner, Charlie Munger, is often overlooked and yet is
unsung hero in
absolutely
that partnership, isn't he?
brilliant.
Yeah.
And a book which is very accessible called The Tao of Charlie Munger by David Clarke. David, I think he was married to Warren Buffett's daughter one stage, and he lives in Omaha. And so he's steeped in that world. But he has taken sayings of Charlie and made some commentary around it. And I just find it's inspirational. This won't tell you
how to buy the next hot stock.
No, but you'll find it will influence your thinking in slightly bigger ways about things to watch out for.
Brilliant. Thank you very much, Rosemary. That was really great. Really enjoyed that. How can the audience connect you if they want to learn more from Rosemary? Is there anywhere they can go?
There's the Downing Fund Managers website. I believe it's actually about to be relaunched, but it does function. They can certainly find fact sheets, and I think there's a webinar, and you can sign up for things on there. That's probably the easiest way.
Excellent. I'll make sure that link is in the show notes below, so just scroll down, you can click that and find Rosemary's profile on Downing Funds. Thank you very much, Rosemary. Really enjoyed this.
Thanks very much. I enjoyed it.
Well, that's it for another episode. If you enjoyed this episode, please subscribe and leave us a comment to let us know. And don't forget to check out our other investor-related podcasts on the Fund Your Retirement Podcast Network. I hope you have a great day, and thank you for listening.